This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 343 was produced on September 29th, 2022. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Mr. Eurodollar himself, Jeffrey Snider, returns as this week's feature interview guest. With the U.S. dollar appreciating to levels few predicted, we thought it would be timely to bring back someone who did predict that move. So this week's feature interview will focus on what the factors are that drive the U.S. dollar. We're also introducing a new show format this week, which includes adding a new personality to our postgame segment to keep things interesting.
And I'm Patrick Ceresna. Eric, before we dive into the new show format, let's take a moment to explain to our listeners why we're changing the format and what brought about this change.
The show format we've been using for 6 years now was conceived when I was running a macro hedge fund. The Market Wrap segment was designed to share my views on the primary macro asset classes, equities, currencies, energy, precious metals, and, of course, bond yields. That format was perfect back in 2016 because I was actively trading all those asset classes in my fund and I had plenty to say about them. But I shut that fund down in the summer of 2018 after realizing that running other people's money just wasn't my cup of tea. Since then, I've stopped trading equities almost completely after figuring out that trading crude oil is both what I'm best at and what I'm most passionate about. So, as I'm sure many of our longtime listeners have already noticed, I really haven't had that much of substance to say about bond yields or equities for well over a year now. Now, I'm interested in those asset classes just like you are because macro absolutely fascinates me. But let's face it, you pay a hell of a lot more attention to markets that you actually trade with risk on the table. And my personal trading now focuses almost exclusively on crude oil. So starting this week, we're going to try a 6-month experiment with a new show format that eliminates most of the market wrap. I'll still do a crude oil segment every week because I have plenty to say about that market. But we're going to drop the rest of the market wrap and address those topics in the post-game segment after the feature interview instead. Needless to say, we picked a hell of a week to make this particular change. With the dollar appreciation going parabolic in the last week, other things are starting to break. So I'll have plenty to say on all the usual asset classes this week, but we'll keep that discussion in the post-game segment after the feature interview, in keeping with the new show format. The other change we're making starting this week is to add new talent to our post-game segment. Patrick, our listeners absolutely love your chart decks, but they tell us the post-game segment's a little bit dry when it's just the same two guys every single week. So starting this week, Nick Galarnik from Optionfinity will be joining us to create a post-game threesome, so to speak. Patrick, since you were the one to recruit Nick, I'll let you explain why we chose him to join the post-game team.
Great question, Eric. I have got to know Nick over the last year, and his style of investing and trading and analysis resonates with me. Over the last few months, I have been collaborating with Nick on some projects and felt he was a great fit to have come on and talk some markets with us.
Patrick, please tell our listeners what topics they can expect in this week's post-game segment after the feature interview with Jeff Snider.
Well, Eric, we are in the midst of a violent market correction, primarily being manifested in the currency and bond markets. We will be taking a look at a number of the currency pairs, including the pound sterling. We will have a look at the charts on the S&P 500, a number of commodities, including oil and gold, and we'll wrap up looking at some of the extraordinary bond moves we have seen that have been all the buzz. Eric, before we move on to that feature interview with Jeff Snider, let's cover crude oil. What's going on, starting with this week's EIA inventory numbers?
Patrick, the story is mostly about the U.S. dollar this week. I think that's what drove oil prices as low as they got. But let's start with EIA inventory. Crude oil drawing down 0.2 million barrels. Now, what really happened is it was a 4.8 million barrel massive drawdown, but 4.6 million barrels came out of the Strategic Petroleum Reserve, making it look like just a 0.2 million barrel drawdown. Cushing, Oklahoma, building a very desperately needed 692,000 barrels. But the big drawdowns on the board were in finished products. Gasoline drawing down 2.4 million barrels. Distillates, another 2.9 million barrels. So we've got big drawdowns across the board in what should be restocking season. Meanwhile, U.S. production ticked back down another 100,000 barrels to 12 million barrels even. Tape action was higher at first after the inventory news came out on Wednesday morning, then accelerated even higher than that when the U.S. dollar seems to have put in, at least for now, a blow-off top and is correcting lower. And that, of course, has helped crude oil prices to recover as well. As far as what to expect from here, the President Biden's SPR drain program is supposed to end in November with the midterm elections. How conveniently timed. Once that happens, there's a lot of question as to what that really means for Russian oil. Is there really Russian oil that comes off the market? I would say not. I think it just means that Russian oil will have to be sold through more circuitous delivery channels that might involve, for example, selling Russian oil to China so that they can refine it and sell the finished products back to Europe without telling anybody that those finished products actually came from Russian crude. There's lots of other ways for that Russian DNA energy molecule to get back into Europe, and I'm sure it's going to find its way. So all of the sanctions are really just political theater as far as I'm concerned. The really big news in energy this week, though, was the apparent sabotage of both the Nord Stream 1 and Nord Stream 2 pipelines. Now, remember Vladimir Putin turning off the gas to Europe and threatening not to turn it back on. I thought the way this was headed was that there would be negotiation between Europe and Putin, and eventually there would be some concessions made and they would get the gas turned back on. A lot of analysts think that that gas is desperately needed, that Germany literally cannot get through the winter, even with what they have already in underground storage, that they won't really be able to get through the winter without huge sacrifices unless they get the gas turned back on. Well, guess what? The gas is not getting turned back on. It sounds like the damage that was done, apparently by intentional sabotage, to the Nord Stream 1 and 2 pipelines was so extensive that it's not likely that those pipelines are ever going to work again. Or at least that's the information that we're seeing as of Wednesday afternoon. So I think this is a big game changer because it eliminates the option of Europe reversing course and saying, okay, Russia, we still disagree with you, but because you've kind of got us by the short hairs, we're going to relax our sanctions in order to be able to buy your gas. Please turn it back on. There's nothing to be turned back on now. So Europe is going to have to get through this crisis somehow without the option of negotiating and coming to terms with Russia. There are accusations that the United States did this intentionally. There are accusations that Ukraine did it. There are accusations that Russia did it in order to make it look like the U.S. did it. There are accusations that, you name it, everybody's got an accusation. Nobody knows for sure what happened here, but it does appear that the attack had to have been undertaken by a fairly sophisticated state actor. It looks like a submarine went and sabotaged the pipelines on the bottom of the ocean. And let's face it, your average 2-bit terrorist doesn't have a submarine. So something pretty significant just happened. Did the CIA do it? We'll probably never know. But I think this could really change the outcome for what happens this winter in Europe. The way I thought this was headed was, unfortunately, Putin was holding most of the cards. I thought he was going to force the hand, make Europe capitulate, and turn the gas back on. That can't happen now. Now, curiously, it did not result in a big spike up in U.S. natural gas prices, so expectations of increasing exports are probably being suppressed by an understanding that it's not possible to export all of the natural gas that's available in the United States. Now, the sterling collapse and dollar appreciation were responsible for a lot of what happened. So the surprisingly low 76 and a quarter or so print on WTI Monday evening is not really what concerns me. What I worry more about is whether this dollar dislocation was just a knee-jerk reaction to the sterling collapse, or if it could potentially signal something bigger starting to break. Now, at this point, it looks like we are seeing at least the beginnings of a blow-off top, and that means that probably it's not something bigger. I still think this is interesting, though, so I want to come back to this after the feature interview with Jeff Snider and talk a little bit more about the importance of watching the U.S. dollar as a potential signal in case we were to get a much more serious macroeconomic dislocation in coming months. I definitely see scope for a big recovery in crude prices, but not until this runaway dollar appreciation comes under control. Is it really blowing off? Are we going to see this correction follow through and get a much lower dollar, or is this just a quick little pullback before the dollar grinds even higher? We'll find that out in coming days, but what happens to crude is going to be based on what happens to the dollar. That really is the governing factor here, and I think the same will be true for gold as well.
This week's feature interview guest is Eurodollar expert Jeff Snider. Eric, why did we get Jeff back onto the show this week?
Well, Patrick, Jeff Snider has been a favorite among our listeners. For anyone who's not familiar with his work, I definitely recommend that you check out macrovoices.com/edu for Eurodollar University. That's a series of several podcasts Jeff and I made a few years ago explaining the inner workings of the offshore Eurodollar system, the system through which U.S. dollars are loaned into existence by international banks. Fascinating stuff. Jeff's work on the U.S. dollar is extensive. And hey, you've got a week when there's a massive, what looks to be a blow-off top, at least in the short term, in the U.S. dollar index with the collapse of the pound sterling earlier this week, obviously being the trigger event to cause that. It's a perfect time to get Jeff back to talk about what the factors are that drive the U.S. dollar. Now, we pre-recorded this interview before this week's market action, so we weren't aware that there was going to be a blow-off top or what looks so far at least to be a blow-off top forming in the dollar index. So that won't be reflected in our discussion, but I will have some more comments about that after the interview with Jeff.
Eric's interview with Jeff Snider is coming up as Macro Voices continues, right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is Jeff Snider, the principal author, first of the MacroVoices Eurodollar University and now of the Eurodollar University podcast. Jeff prepared a terrific slide deck to accompany this interview, and I strongly encourage our listeners to download it because we're going to be making extensive references to the graphs and charts that it contains. You'll find the link for the download in your Research Roundup email. Now, if you don't have a Research Roundup email, just go to our homepage, macrovoices.com. Look for the red button that says Looking for the Downloads. Jeff, it's great to have you back on the show. We decided, instead of talking about today's markets and so forth, to do kind of a timeless episode talking about the U.S. dollar, why it is still at the center of the global financial system, despite the fact that ever since 1971, the U.S. has kind of been frustrating some of the other countries around the world by maybe overstepping the authority that it gets from having the dollar at the center of the global financial system, yet it still remains king. And particularly, I think a lot of people would really like to better understand what causes the dollar to go up or down against other currencies. Now, if you pick up a macroeconomics textbook, pretty much what we're taught is that interest rate differentials are what control currency values. So, for example, if the Japanese yen pays a much lower interest rate than the New Zealand dollar, then you can expect international investors to borrow yen at very low interest rates, sell them in order to buy New Zealand dollars, and get a much higher rate of return on New Zealand treasury bills than they had to pay in order to borrow the yen. That's, of course, known as a carry trade. I got a feeling, Jeff, you're going to tell us that there's a little bit more to it than just that when it comes to the U.S. dollar.
Yeah, and it's a good place to start, Eric, because you're right. The textbook is pervasive and the textbook opinion is pervasive for good reason, because that kind of thing does happen. There are enormous carry trade forces out there in the world. And as you mentioned, yen to New Zealand dollar, I don't know how popular it is, but I imagine someone somewhere at some bank or some firm in Tokyo is probably working on something like that, because let's face it, Japanese banks have all sorts of yen on their hands and all sorts of time during the day to do something with it that doesn't involve a domestic Japan. So I think, first of all, there's two important points here. The one that you first raised, which is that the U.S. dollar is still standing. And in some ways, that's regrettable, because the U.S. dollar system, the Eurodollar system, doesn't really work for the U.S. or anyone else around the world, but yet it remains, and there's a reason why, and we'll get into that. And the second thing is that it's incredible. It's more complicated than just carry trades. Carry trades are part of the investment process. They're part of the investment world, but they're also, we have to keep in mind the Eurodollar and the U.S. dollar denomination is the global reserve currency. And as a global reserve currency, it has to fill these very necessary, very large, very sophisticated roles. For example, just in the carry trade example that you just used, going between yen to New Zealand dollars to take advantage of interest rate differentials, most of the time you're not going to go directly from yen to New Zealand dollar. There's going to be an intermediary currency in between. You're going to go into the U.S. dollar to intermediate between those, especially if you're talking about more than just speculative investment. If you're talking about foreign direct investment or any other kind of opportunity arbitrage that's out there between currencies, by and large, more often than not, you're going to intermediate through the U.S. dollar, which means the U.S. dollar is actually in the middle of what should be a simple interest rate differential arbitrage case. And I brought a slide deck along so we can start out going through some slides. And if you go to slide number 3, you're exactly right, Eric. I mean, it's not just interest rate differentials. The textbook says that interest rate differentials themselves are a matter of central bank policy. So the differences, for an example you had, between what the Bank of Japan might be offering and then pushing rates inside Japan versus what the Reserve Bank of New Zealand is doing, and then therefore interest rates differential with New Zealand. And of course, with the U.S. dollar, everybody thinks Fed, 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 Fed. It's all about Fed policy on the one side of the differential, the U.S. dollar side. But if you go back through even just recent history, so we're going to go through slide 3 to 4 and now to 5, what you find is it doesn't really work that way, at least not in the spot market. In forward markets, obviously, interest rate differentials help you set what your forward prices are going to be when you're doing currency swaps at any given time during the day or during whatever portfolio strategy that you're trying to follow. But in the overall context of the U.S. dollar's exchange value versus any number of the major currencies, and we'll just use DXY here, because DXY is the major dollar index, what you find is that DXY, or the dollar, kind of does its own thing independent of whatever the Federal Reserve policy is. So if we review the last couple of years going back to 2017, first you see the Fed is hiking interest rates in 2017. Remember, globally synchronized growth, inflation expectations were supposedly rising, and the dollar seemed consistent with all that, including the Fed doing quantitative tightening or balance sheet runoff because it was confident the economy was good, which is kind of what we see consistent historically with a weaker dollar. Then all of a sudden in early 2018, the dollar changes direction. It starts to go higher. So the dollar changes, but the Fed did not. If anything, the Fed got more aggressive. So it got more into rate hikes, more confident about quantitative tightening. And then, of course, it didn't really work out that well in 2018. And then to 2019, the Fed changes again, but the dollar doesn't. The dollar continues to go modestly higher while the Fed suddenly starts cutting interest rates, as well as abruptly ending quantitative tightening and then doing its not QE5, which was Treasury bills in the wake of the September 2019 repo event. And of course, move forward to the COVID pandemic, all that stuff. Fed doing lots of QE in 2020 and 2021, but again, very abruptly in early 2021, just when everybody's thinking this wave of money printing is finally washing over the system, the dollar starts to go higher again. So again, it doesn't matter what the Fed does. The dollar seems to act independently of whatever the Fed. And it's been this way historically speaking. Go to slide 6, go back to the pre-crisis era. Again, the Fed does one thing, the dollar does another thing. The Fed does the same thing, the dollar goes in a different direction. So 2004, the dollar kind of goes down, even though the Fed's hiking rates. Then from 2005 into 2006, the dollar's kind of going back up, even though the Fed hasn't changed, and the dollar goes weaker again. Again, the point we're making here is that at least so far as the Federal Reserve is concerned and Federal Reserve policies are concerned, there is no direct relationship. And really, there isn't very much of a correlation whatsoever between the monetary policies or the interest rate policies of the Federal Reserve and the direction of the dollar. And probably the most extreme example of that, in addition to March of 2020, we have the middle of 2008, when the Fed was ultra dovish, according to most mainstream sources, but yet the U.S. dollar spiked and surged because the U.S. dollar is reacting to conditions that aren't necessarily related to the Federal Reserve. And just to put one more point on interest rate differentials, if we go to slide 7, we'll take a look at the difference between what the Federal Reserve is doing and what the ECB is doing and how that plays out with regard to the U.S. dollar euro exchange value. And again, sometimes it looks like the textbooks, most times it doesn't, especially in the real thick of the crisis in 2008 and into 2009, where the euro is actually seriously declining against the US dollar, even though at that time interest rates were extremely favorable toward Europe, including the fact that the ECB actually did a rate hike in July of 2000. It was June or July 2008, can't remember off the top of my head. So despite the fact that the interest rate differentials were supposedly euro positive, the euro actually tanked really hard in 2008 because, again, what happened in 2008? What was it that makes the U.S. dollar move the way it does? It's that kind of a thing. That's kind of fundamental euro dollar story that doesn't make it into the textbook, which is usually about what is whichever central bank on one side of the interest rate differential supposedly doing. We're taught and told over and over to filter everything we look at in finance, economy, and markets through the lens of central banking and monetary policies, when it just doesn't stand up to any evidence.
Jeff, you're kidding me. It turns out that the central bankers are not actually in charge of everything the way they think they are. Well, how about that? So if it's not central banks and it's not just interest rate differentials, that begs the question of what actually does determine these things. And I know, because I'm familiar with your work, that it's going to hinge on the global market for borrowing and lending dollars, which is known as the Eurodollar system. Now, you and I did an entire series called Eurodollar University, which is available at macrovoices.com/edu. But for anyone who may not be familiar, let's start with the fundamentals of what Eurodollars are and how they have anything to do with dollars, and what do the international market have to do with the value of the U.S. dollar?
Yeah, it's as usual, Eric. As you know, it's an incredibly complicated, very detailed, and very deep historical story that goes way back into the 1950s, and really earlier than that for some of the technological and banking evolution fundamentals about the system. But by and large, we have a global Eurodollar system, which simply means U.S. dollar-denominated bank liabilities, reserveless virtual currency, ledger money, however you want to characterize it. But it's not actually a system of physical currency or any money. Forget it. I mean, there's no gold here. Operating primarily outside the United States, but it's not like they're different systems. It's not like there's an offshore Eurodollar system and an onshore domestic dollar system. The two are very much linked. And up until the 2008 crisis, they were operated in almost seamlessly linked fashion. And some of the ways you could see that happen is by the way foreigners began to accumulate massive balances of U.S. dollar assets, most of which were custodied domestically. So, for example, you could see in the tick data, foreigners were tended to buy huge amounts of US dollar assets, particularly US Treasury securities, whenever there were a lot of dollars operating in this Eurodollar system, sloshing all over the world, that had nothing to do with the Federal Reserve. It was all about banks creating their own liabilities and then trading them and transacting them all throughout the world, as we said before. The Eurodollar system intermediating between merchandise flows as well as financial flows. And the more there were of these Eurodollars, the more there was governments, banks, foreign institutions buying US dollar assets to hold as reserves, because that's only the prudent thing. That's what governments and banks had been doing historically speaking. They're always held correspondent balances. So really the only Eurodollar innovation, as far as that much is concerned, the store value and reserves, is the introduction of US Treasuries. And it goes all the way back to the beginning, as we'll see in a minute. So picking back up on the slide deck, I want to go to 1997 and 1998, just to give you a little bit of a historical vignette or anecdote that ties these things together. So you have governments that are holding reserve assets in U.S. Treasuries because of this massive gross Eurodollar expansion. But then in the fall of 1997, we have this little bit of a hiccup. It started in Thailand and it kind of spread throughout the rest of the Asian markets. And it hit Japan pretty quickly too, because Japan was already in the midst of its lost decade. And once this Asian financial crisis reached some of the Japanese banks had funding problems because they were short US dollars. They were participants in the Eurodollar market. And when local banks in any jurisdictions find themselves in the opposite side of the Eurodollar system, where funding becomes less and less reliable, less and less predictable, more expensive, or maybe disrupted altogether, local banks tend to run to their central bank, their local central bank, and say, hey, can you fix this for me? Can you sell some of your reserves in order to help me pay back these Eurodollar loans that I've taken out to do all of the things that global commerce requires me to do? And in May of 1998, this is a FOMC discussion, Peter Fisher, who was the Reserve Open Market System Manager, recognized through his contacts and told the FOMC that U.S. banks in particular, they were willing, again, arbitrage here, they were willing to take advantage of this steep premium that was the dollar premium that was being charged to Japanese banks, but that they were running against credit and some of their internal constraints. So from May 1998 onward, U.S. banks were not going to be supplying U.S. dollar funding through this Eurodollar system to Japanese banks, which required Japanese banks to do all sorts of other things, including fire sale assets in some of the worst cases. And some Japanese institutions did end up failing throughout 1997 and 1998. But to try to prevent all that from happening, if you go to slide 10, now we're in February 98, a couple months before Mr. Fisher saying that the U.S. banks are cutting off their Japanese counterparts. The government of Japan had essentially pleaded with the Fed to sell treasury bills that the Japanese had. I can't remember if it's in the custody of the Ministry of Finance or if it was directly in the Bank of Japan. But either way, they begged the Fed to essentially sell treasury bills on their behalf so nobody would know that they were selling treasury bills, so that they could raise dollars to help supply these to the local Japanese banks. They couldn't raise them from the Eurodollar system. And to this day, we have no idea how much the Fed actually sold, what was actually going on, because as I've shown, as you see on the slide here, all of these four blanks, those numbers as well as the text has been redacted. To this day, 25 years later, they still don't tell us exactly what they did on behalf of Japan. The reason I'm bringing this up, because it ties together a couple of very big misconceptions that the public, people at large, largely have, which is that foreigners selling their treasury securities has nothing to do really with those treasury securities. It's not about the credit risk. It's not about the government going crazy in the United States, which it has. It's not about that they hate America. There's no politics here. It is simply Eurodollar money mechanics. And it goes way, way back, not just 1997, 98. If you see just to show you the data of this happening on slide 11, as soon as U.S. banks cut off their Japanese counterparts, on the tick data, we see suddenly foreigners are foreigners not identified here, but we know they're Japanese, that were being forced to sell their U.S. dollar assets because that was their only way for them to make up this Eurodollar shortfall, this global or regional dollar shortage that was spreading across Asia. And specifically, foreign institutions, official sector on slide 12, you can see a couple periods where the Japanese primarily were being forced to sell their U.S. Treasury notes, not because they hated Bill Clinton, because they didn't like the idea of impeachment. It wasn't because they hated the Fed or Alan Greenspan. It was simply euro-dollar mechanics. And if you go to slide 14, we'll skip ahead a couple here to slide 14. This was nothing new in 1997 and 1998. As I said before, this goes all the way back to the beginning of the eurodollar system, because the eurodollar system itself is primarily a medium of exchange. It's not really a store of value, and it was never really meant to be a store of value. That's where treasuries come into it. That's where things like Eurobonds come into it. These financial markets that were taking on the monetary role of store of value, so that the eurodollar banks could engage in this virtual reserveless currency that acted as a pure medium of exchange. So even from the very earliest days, the system had always linked central banks holding U.S. treasuries as a reserve store of value in case of any payments processing shortfalls or any eurodollar funding problems that arose. And they have been part of the marketplace from the very beginning too. On slide 14, you can see an FOMC discussion from 1963, where the FOMC is talking about how, again, the Japanese government were forced to sell treasury bills in order to allow their commercial to then lend the proceeds to their commercial banks to pay off eurodollar loans that the eurodollar market was depriving them of. So going back to slide 13, we can start to really piece together what's going on here. Whenever governments are selling their treasury, governments in particular, but also private institutions too, whenever governments in particular are selling their treasuries, guess what we find? We find a very good correlation, as you can see on slide 13, with government activities in the buying and selling of particularly U.S. treasuries as reserve assets and the direction of the U.S. dollar exchange value. Just to note on this slide, I'm showing you DXY inverted so that it matches more closely with the tick data. But whenever you see governments selling treasuries, that's usually an indication the U.S. dollar is going to rise. And as we know from the Japanese example, going all the way back to the 1960s and before, as reserve assets, if they're selling reserve assets, that means dollar shortage, euro-dollar funding issues.
Jeff, you mentioned a couple of times in that description situations where, hey, nobody was upset with the United States. It wasn't about that. It was the mechanics of the Eurodollar system. Well, it seems to me that in 2022, we do have a situation where there's a new historical event, which is the seizure of Russian foreign exchange assets caused a lot of people to become concerned about divestiture of foreign exchange assets by other central banks, basically saying, look, regardless of what Putin may have done in Ukraine, the United States took this action without any due process of law, without any action of a judge or a court. It was basically an executive decision by President Biden to seize their foreign exchange assets. And a lot of people predicted that that would change the attitude of central bankers around the world and cause them to say, hey, wait a minute, this whole idea of making U.S. treasuries the go-to reserve asset, hey, that's got to go. And there has been divestiture both by central banks and by private holders of U.S.-denominated securities since then. So is there a new fundamental driver here where we could see the concerns about foreign divestiture of U.S. assets change this equation? And if so, what are the consequences?
Well, I think, number one, first of all, the Eurodollar story itself goes back to that same fear. One of the origin stories for the Eurodollar system in the 1950s was Russians fearing U.S. confiscation of their dollar balances that they held in U.S. banks or with U.S. banks in the 1950s. Of course, the early Cold War, back 1950s and 1960s, early 1960s, some of the hottest parts of the Cold War. So this is actually nothing new. And in one sense, this is what the Eurodollar system was built to avoid, because when you have a global bank network that's operating not just offshore outside the United States, it's offshore everywhere. It's outside of regulatory jurisdictions in pretty much any place it operates, because that's kind of the point. The point was to move beyond the reach of whatever global authorities, including, itchy Americans who are only too willing to go beyond what the British saw was a step too far. I mean, the British mercantile system that pre-existed the Eurodollar system, Even the British government during whatever wars they were fighting, and they knew you never did that. You never went as far as to confiscate even an enemy's financial resources because of the precedent that would set and what it would do to the actual monetary system and the faith and confidence in it. But the Eurodollar system, the US dollar in particular, has been different because from the very beginning, confiscation has been a full part of its development, not just the Russians or the Eastern Bloc communists, but various political parties, various governments, various private corporations around the world who have been accessing this offshore global dollar system because it is beyond the reach of the government. It's beyond the reach of the Federal Reserve. It's beyond the reach of the Treasury Department. That's the part that the mainstream convention about the U.S. dollar as a reserve asset gets wrong when it's the euro dollar as a reserve asset. Because it's a bank-centered system, it's outside the regulatory reach of most of the governments that are surrounding it or trying to influence it. There's the other part of this, Eric, as you mentioned, is U.S. Treasuries as reserve assets. And U.S. Treasuries as reserve assets aren't really that complicated either. As I said before, the reason why governments have been using U.S. Treasuries is not because they either like or hate the United States, but because there's a deep, sophisticated liquid market associated with it. And when we get into things like repo, which is one of the most, one of the most crucial aspects of liquidity across the system, U.S. Treasuries are primary, not because people like the U.S. or they like the Biden administration or anything like that. It's only because of the marketplace surrounding it. And unless and until there is a competing marketplace for some form of collateralized market, then the U.S. Treasuries are basically it. And that's kind of the theme that we're developing here throughout this whole presentation, is that we're regretting the fact that the Eurodollar system is still a reserve currency. We're lamenting the fact that it doesn't work, but it's still here. It's still, the dollar is still king simply because there is no alternative to it. And I know people like Zoltan Pauser has speculated that we're going to develop a less treasury-centric system and use commodities, which to me is absolutely absurd because commodities are the very reason we moved away from the old mercantile system to begin with. Cumbersome settlement, lack of liquidity, all those types of things.
Jeff, let me spin this another way then. Let's suppose that I am a central banker for one of the major large central banks in the world, not the Fed, somebody else. And I hire you as a consultant. I say, Jeff, you're the smartest guy there is on this Eurodollar system. Look, we really are very, very, very concerned about the U.S.'s abandonment of the rule of law and what they did with Russian reserves. Because just as you said a minute ago, even with your worst enemy, you don't want to set that precedent of extrajudicial seizure of assets because it undermines your currency system as the global reserve system. So suppose that a central banker for a major central bank said, Jeff, we need your help. We want to ditch the dollar, the whole Eurodollar system, but we know that it's deeply ingrained throughout the whole financial system. So tell us what the challenges are. What things do we have to overcome? And what asset, if it's not commodities, and we want to get rid of the dollar because we don't trust the American government anymore, what should we use instead as reserve assets?
Well, that's a two-part question too. And the first part is, what do you need to do? You need to create a system that can fill all the roles of a reserve currency. I'm thinking about Robert Solomon's 3 pillars of a reserve currency, which is liquidity, adjustment, and confidence. And those are tricky things. What he means by liquidity should be pretty obvious. You have to have an ample amount of liquidity, which is liquid resources that are easily tradable, easily settled across vast distances. And because it's a reserve currency system, what that means is it has to be available in enough liquid supply all over the world or all over the block. If you're not trying to create an alternative global reserve currency, but just a regular individual currency block or a geographical currency block, whatever it might be, you have to make sure that that currency is available in ample supply wherever it's going to be used. And that's a real tricky thing. And that's the reason why the Eurodollar system has lasted as long as it has, because it has, for many, many decades, developed infrastructure into all parts of the world. People know how to use the Eurodollar system, SWIFT being a small part of it, but a good example of how it's standardized, how it's easy to use, how it's very, very simple to operate, but yet incredibly complex when you actually think about what happens. There are millions and millions of messages that are sent across the SWIFT system or the chip system or the global Eurodollar architecture that are easily and predictably and very reliably settled across the whole thing. So starting out with a competing reserve currency, whether it's global or regional, you have to make sure that there's infrastructure available to make sure that it's liquid throughout the entire geography of where you're going to develop this currency system. And that's a really tricky thing that takes a long period of time. And then the second part, which I think is the most important part, where the Eurodollar really shines at least in its early days, was adjustment. Adjustment is really just the acknowledgement that we live in a ever-changing world. This is not a static world. Because the Eurodollar was a bank-centered system that was operated by, for lack of a better term, greedy bankers who would do whatever they could to make a nickel, they were very nimble. So if some part of the Eurodollar system wanted to experiment or do something different that the system hadn't done before, the banks operating in it were very flexible enough that they could adjust to the needs of their customers. So the currency system itself could evolve and change with circumstances. They could evolve with technology. They could evolve with, political flows or political winds, whatever it might be. That the system could constantly change, constantly evolve, and constantly adjust. And it's very difficult, if not impossible, to replicate that kind of function or that kind of capability in a rigid top-down structure. And if you're trying to develop an alternative reserve currency system, and you know that it can't be a rigid top-down structure, that means you have to embed within it all sorts of legitimate organic incentives that allow private enterprises to compete within it so that they can be flexible enough. You can have competition that produces winners that leads to this sort of flexible adjustment function. And then, of course, the third pillar from Robert Solomon is confidence, which is it's as hard to describe as it is to think about, because confidence is more of an emotional thing than anything. And part of confidence comes from the fact that once you have this system set up, it works the way it's supposed to work. And in most cases, that's what the Eurodollar system has been up until, at least it had been up until August of 2007. But even now, over the last 15 years, when it doesn't work in the way it's supposed to, it doesn't work in the way we need to, because it's so hard to develop and implement a competing currency arrangement, it's kind of all we have left, because these three pillars of a reserve currency are not something you just slap together overnight. And it's not really something that's, at least with the current lack of urgency, the current lack of political will in most places around the world, there really hasn't been any real thought into developing something like that. I know people have said the Chinese are going to do it, and they've been thinking about it ever since Zhao Shuaishan first mentioned it in March or April of 2009. We're gonna build a yuan-based currency system. Well, the Chinese quickly abandoned it because they realized it was beyond their capabilities. So without really a global effort to do something like this, we're kind of stuck. So what you're saying, Eric, is true, but it's also the regrettable truth here that we're trying to get at, is that the Eurodollar system has done all these things better than anywhere else, even though the Eurodollar system is regrettably, it's still there, but it doesn't really work all that well. And it includes the idea that maybe, just possibly, the U.S. government can start doing things that it really shouldn't be doing. Now, the only positive, or the only, depending on how you want to look at it, the only positive about that is that even if the U.S. government, even if the U.S. Treasury Department, for example, should just out of the blue happen to sanction some Russian banks, what you find, or cut them off of SWIFT, for example, what you find is that doesn't really mean that they're actually cut off from the global Eurodollar system. And even if the U.S. government and Treasury Department were to say U.S. banks can't do business, and any balances that Russians have in whatever U.S. banks, well, because the Eurodollar system is a bank-centered offshore system, the Russians can simply move to other parts of the system that the U.S. Treasury Department cannot reach. So again, that's part of the adjustment function of a reserve currency. And I think that's one reason why the Eurodollar continues to survive. And I don't see what's going on in Russia is really that different, because, again, like I said, confiscation has been an ever-present issue in the Eurodollar development from the very beginning. And the fact that it's actually starting to happen, that's all been game planned and thought out already.
Let me change the question slightly then. Suppose that a major Silicon Valley concern, Google, Apple, somebody like that, were to hire you and say, Jeff, look, here's what we think. The world needs a new digital currency. And the central bankers have figured this out. That's why they're talking about CBDCs now. But they don't have the technological wherewithal to do it. So we want to design a new global reserve digital currency system. And we're trying to figure out how to do it. And because we're basically talking about programmable money, we know that we can deliver some really cool monetary policy features that central bankers haven't even dreamed about yet. And we want to be able to sell this thing to central bankers. But the thing is, we also can see how deeply ingrained the Eurodollar system is, and also how all the foreign exchange markets, like you say, everything, all the liquidity is exchanging into and out of U.S. dollars. If we want to take on the dollar and compete with it with a new digital currency system, what's the best way to go about that? Should we be backing it with commodities? Should it be gold-backed? Or what should we do? What would you tell them?
That's exactly how I'm thinking too, Eric, because I think that is the future that we're going toward. And I share your central bank digital currencies. Forget it. They're not real digital currencies. They're not native solutions whatsoever. And you're right. Some of the few contacts that I've had with some of the officials, I can't say where, they don't get it. They don't have the technological capabilities. And I don't think they have the intellectual fortitude either, because they don't really understand the situation they're trying to get into. They're simply reacting to the fact that the private marketplace has proliferated, absolutely proliferated. Digital currencies, cryptocurrencies are everywhere, despite the fact that various points along the way, they've tried to kill them. And in fact, they've only thrived more because the private marketplace knows there is a need for a competing currency. Even if most people don't know what that is, crypto bubble, everybody thinking store of value, when in fact it's really about the lack of elasticity in the Eurodollar system, meeting medium of exchange type functions. So it's not really central bankers. And what advice I would give to anybody in Silicon Valley is simply proof of concept. Prove that your currency can work as a medium of exchange in all the ways it needs to. It can hit the three pillars Robert Solomon talked about 50 years ago. And once you do that, I think you get into a situation like Gresham's Law, where eventually over time you have a digital currency that wins more and more and more adherence. And as it wins more for medium exchange, not store value, for medium exchange functions, and as it does, it quietly over time supplants the Eurodollar system in the same exact way the Eurodollar system quietly over time supplanted Bretton Woods long before August 1971. In fact, you can hear some of the FOMC officials. I didn't include the quotes in my presentation here, but the FOMC had already talked about in the early 1960s how this Eurodollar thing was actually providing liquidity, providing these roles of a reserve currency that the Bretton Woods system could not, even at those early days. So the task for digital currencies is to prove you can meet these functions of money, these functions of a reserve currency, and do so reliably, predictably, and in a transparent fashion. And I think that's really all that needs to happen. Now, as far as the financialization, some of the more details behind it, those are things that need to be sorted out. But the big picture of it is we have a malfunctioning Eurodollar system that is ripe for the taking. And it only takes a matter of somebody doing it right in order to create an alternative that will, I think, if it works, just kind of take over.
Oh, I couldn't agree more, Jeff. And the way I look at this is what's going to happen here is first we had Bitcoin, which was the proof of concept that shows, I think of it like the Wright Flyer. It shows that human flight really is possible in a heavier than air aircraft. And that was a profound breakthrough. A whole bunch of silly people thought that Bitcoin was going to take over the financial system, and I think that was misplaced. Then the next,
I still think that today.
Well, some of them are coming back down to earth along with the price of Bitcoin. But at the same time, the next thing to happen was a bunch more silly people said, oh, central bankers will create their own digital currencies. Yeah,
and they will.
And I'm going to win the Miss America contest. Right. That's exactly. Fine. They don't have the technical wherewithal to do that. But what's needed here is...
You're so far behind.
But what's needed here, Jeff, are digital currency systems that the central bankers feel like they own and are in charge of, unlike Bitcoin, which was designed explicitly to frustrate and annoy central bankers. So my contention is all that Silicon Valley has to do is design a global scale digital reserve currency system, which is designed with features to appeal to central bankers. So they can go to all the central bankers of the world and say, look at this. You can keep your reserve assets in US dollars, or we can show you this programmable money that gives you profoundly more functional monetary policy tools than you could ever have in any conventional currency system. And it's ready to go, and it's fully scalable, and we took care of the technology for you. And by the way, we want to cut, and you should adopt this as your new reserve system. And I think that could very easily take over the global financial system as a new global reserve currency. By the way, not putting the United States in a very good position along the way. U.S. tech companies that create that technology would then find themselves very much at odds with the U.S. government. And I think it's going to be a very interesting road to hoe when we get there. Any thoughts?
No, I think there's a lot what you said there that is actually has to happen, right? Because governments are going to have a say in that. And I know that's the thing that you've said from the very beginning. You said it a lot in your book. You made that point specifically that what the Bitcoin people, for lack of a better term, got wrong was that they made Bitcoin specifically to be anti-government. And so it was never going to be adopted in any widespread fashion. Yes, there's the occasional outlier like El Salvador, but it was never going to be a widespread. And there's other problems with it too. But I think, Eric, that's the challenge is because you need to make a digital currency that actually works, there's going to be some natural tendency or natural tension with also trying to make it sellable to government officials, because let's face it, government officials, whether it be central bankers, treasury departments, finance ministries, whatever, their tendency is to screw everything up. So it's going to be a very, very tricky challenge to get a currency that works reliably so that it can be adopted. At the same time, it's also acceptable to governments who at least maybe you can fool them into thinking they have some sort of ownership of it or some sort of influence over it. But there's that natural tension because the more they get involved, the less it seems to work. And the less it seems to work, the bigger the challenge or the bigger the hurdle will be to get widespread adoption.
Jeff, let's come back to your slide deck. I think we left off on page 15. Tell us the rest of the story here with respect to the U.S. dollar and the system that we have today.
Well, I think we spoiled all the good stuff to begin with, because what we're really basically saying here, Eric, and what I'm really showing you here is that the U.S. dollar, when it goes up, it correlates very closely with other indications of global dollar shortages, not just foreigners selling their liquid U.S. Treasury reserves, but also financial markets, the deep, sophisticated financial markets, such as the U.S. Treasury yield curve, which I'm showing here on slide 15, especially in the post-crisis era, which makes sense when you have low and flat curves to start with. Whenever you see the yield curve steepen, that's usually when the U.S. dollar falls in exchange value, which again, I'm showing you DXY inverted here just so you can see on the slide, or just so you're aware of on the slide. Whenever you see the yield curve flatten, which is a very serious deflationary tight money probabilities scenario, the U.S. dollar doesn't just tend to rise, it rises almost in a one-to-one correspondence. Go to slide 16, that's the 2-year, 10-year spread. On slide 15, it was the 5-year, 10-year spread. Again, same thing. U.S. Treasury curve tends to flatten. That's not good, which means the U.S. dollar is going to be going up in exchange value. At the same time, we're going to be seeing foreigners selling U.S. Treasuries. And other financial indications, a big one for me is U.S. dollar swap spreads, which are the difference between the quoted leg of an interest rate swap and the same maturity U.S. Treasury, which tells us something very, very deep and very fundamental about the dollar marketplace itself, because it is these global banks that operate the Eurodollar system that are trading in these swaps. And trading in swaps requires a couple things, including some of the most fundamental properties of the Eurodollar system, which are collateral and balance sheet capacities. And you can't do long-dated swaps without those two things. So what we see is swap spreads tend to compress, which is the thing they shouldn't be doing. At the same time, the U.S. dollar goes up in value. So what that tells us is when banks are balance sheet constrained, when banks are collateral constrained, which are very tight money indications, that's also the time when we see the yield curve flatten. That's also the time when we see foreigners selling their treasuries. That's also when the US dollar goes up in exchange value. And it doesn't matter the tenor of swap spreads. If you go to slide 18 now, that's the 5-year swap spread versus slide 17, which is the 30. Again, same thing. Swap spreads tend to compress when we see tight money across all these various indications. Some scholarship that has been done recently about swap spreads, just confirming what we already knew, that the Fed and some of these international organizations like those like the BIS, they're starting to realize that some of these fundamental Eurodollar properties are very important, and that bank reserves that the Fed does create are not money, and they're not as important or at all important. Again, you need collateral, you need balance sheet capacity. That's swaps. That's why the dollar moves. That's why we have a dollar shortage. Same thing on slide 19 and 20. Basically, some background behind the swaps market and why that's a deep fundamental monetary indication. And another one on slide 21, especially since 2013 and 2014, when the Asian markets really got slammed hard by what we call the third Eurodollar shortage, or Eurodollar number 3. There's a very close correlation between the direction of the US dollar spot exchange value and the number of treasuries, the balance of US treasuries being held on custody by the Federal Reserve Bank of New York on behalf of foreign official and foreign private commercial bank institutions, which is an indication of collateral scarcity. So once again, just reinforcing the knowledge here, or reinforcing the message here, which is the correlation between the US dollar's exchange value and tight or loose money, not because of the Fed, but because of the Eurodollar system itself. And again, this is something that's not, maybe the public isn't really aware of it, but if you go to slide 22 and then 23, there's been all sorts of academic scholarship very quietly been conducted. The quote here from a paper that was published in 2018, strong negative relationship between the US dollar and cross-border bank lending denominated in US dollars. Again, after everything I've showed you, that only makes a whole lot of sense, but yet this is kind of emerging scholarship in official academics. There's one that goes back to 2013, a fellow by the name of Hong Young Shin, who's a pretty well-known BIS researcher, along with Valentina Bruno, talking about how the US dollar is a bellwether for global financial conditions. So the punchline, the overall conclusion here, is that everything that we've been taught, everything that's been put into the textbook is Fed-centric, which isn't actually the case. It isn't actually how it works in the Eurodollar system itself, because it is a global offshore bank-centered system. Therefore, what matters to the global offshore bank-centered system is whatever's affecting these global offshore banks that operate within it.
Jeff, final question. Let's suppose that at some point we do see the situation which Luke Groman has predicted, where the writing is on the wall. Maybe Google has introduced a global reserve currency system and is off-selling it to central bankers, and people around the world are realizing that the U.S. dollar's days are numbered, that it will be replaced. When you and I first started talking about the U.S. dollar someday losing its hegemony over the global financial system, it was crackpot conspiracy theory stuff that nobody took seriously, or almost nobody. These days, more and more people are waking up to, yeah, that's coming someday. We're not there yet because there is no viable alternative. But boy, when there is a viable alternative, the world could change quickly. I want to talk about what happens when that happens, because the obvious conclusion to draw is, well, if people know that the U.S. dollar is going to go out of vogue, that can only mean that the value of the dollar has to go down dramatically. But as I think about what's happened in the oil market, where most of my trading is focused, as we've decided that oil has to be phased out, what happened was everybody stopped investing in finding new producing resources, and we're seeing the price going to the moon instead. So I wonder if the world thought, if the banking system thought that the U.S. dollar was going out of vogue and Google money was going to take over. Does that mean that the Eurodollar system breaks down? Foreign banks stop making more Eurodollars, just as we've stopped exploring for new oil fields? And that actually surprises everybody with the U.S. dollar going up dramatically in its final years of service as global reserve currency? Or does it go the other way?
What you just described is the past 15 years, Eric. That's the funny thing. The U.S. dollar has gone up for exactly the analogy that you presented, which is that U.S. banks, for lack of a better construction here, they've stopped making Eurodollars because the investment hasn't been worth it in their minds. The way bank-centered money works is everything is priced and everything is thought about. Everything is added to a balance sheet based on risk-adjusted return perception. And since August 7th or August 9th of 2007, the banking system has decided that it's not really worth the extra effort to create more balance sheet capacity and collateral and everything else that requires the Eurodollar system requires to operate. So the banks are way ahead of you here. They've stopped investing in their own capacities 15 years ago. And I know everybody likes to attribute that to regulations that came along after the crisis, whether it's Dodd-Frank, whether it's Basel III and whatnot. But those just codified what banks were already doing under their own balance sheets, which was they've stopped manufacturing Eurodollar capacity because they don't think it's worth it. And we've been struggling with the fallout and the consequences of it ever since August of 2007. And that's why the dollar has gone up in price because, as you just astutely pointed out, Eric, like the oil market, if you don't invest in the infrastructure, eventually that's what happens. Dollars become scarce, even as maybe there is a potential competing currency system that arrives on the scene at some point and starts to overtake some of the roles. That doesn't necessarily mean the price of the U.S. dollar is going to fall to zero. It might continue to go up as the global banks that operate the system continue to invest less and less of it. Think about the Venezuelan example. I mean, the Venezuela doesn't put much into their oil capacity at all, and so it just they don't invest, so it just dwindles. And that's really, when you look at bank balance sheets throughout the Eurodollar market throughout the world, that's what you see. There's a lack of investment in balance sheet capacity for a number of reasons, including the liquidity risk, the tendency of the system to go awry intermittently. But for whatever underlying and overlaying causes, banks aren't creating money, and that's really the problem here.
Well, Jeff, I can't thank you enough for a terrific interview, but before I let you go, I want to talk about the work you're doing on Eurodollar University. Now, this started between you and I did a series of podcasts called Eurodollar University, or MacroVoices Eurodollar University. Listeners, you can find that series, which is as relevant today as the day it was recorded, at macrovoices.com/edu for Eurodollar University. Meanwhile, our good friend Emil Kalinowski has helped you to take that work forward, and now you have a podcast called Eurodollar University where you talk about these concepts every week. Tell us a little more about what work you're doing and how people can follow it.
You're right. I mean, Eric, you and I started this many years ago. It feels like a long time ago, where we looked at, you basically, the challenge was, hey, let's investigate this Eurodollar system. Let's understand the Eurodollar system. And we took our stab at it and realized there's so much more there that it actually requires an ongoing effort that, as you said, Emil Kalinowski has generously donated his time to help me put together a podcast, as well as some other efforts too, where we try to continue to get into the history, the fundamentals, the transactions, the implications of all this Eurodollar business. Try to look forward, look at digital currencies, look at competing alternatives to see where this thing might end up down the road, and just put it all into a weekly podcast format that you can find on YouTube or iTunes. I think are the two biggest ones. It's called Eurodollar University. And we really just try to take a deep dive and look at everything that's going on through the lens of the global reserve currency system as it actually is.
And the URL for your Eurodollar University website couldn't be easier to remember. It's eurodollar.university. Patrick Ceresna and I will be back as MacroVoices continues right after this. After being completely sold out of advertising space for the last couple of years, we finally have capacity to add a new advertiser. MacroVoices has a PodTrack certified global audience of over 170,000 listeners, and each weekly episode typically gets 60,000 to 80,000 downloads. We have more than 20,000 accredited investors who have registered with us as accredited, and we estimate the total accredited investor audience as at least 40,000 accredited listeners, which we believe to be the highest number of accredited investor listeners of any podcast on the internet. We strive to accept tasteful advertising from advertisers whose product is likely to appeal to our audience. So we're looking for another investment or financial services advertiser to fill the space I'm speaking in right now. Mail-order Viagra salesman need not apply. If your company wants to advertise on MacroVoices, please email sponsorship@macrovoices.com for more information. Now let's get right back to the show.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Jeff back on the show. You know, his views on the dollar were just so relevant. What did you take away from the interview?
Patrick, I think this week's action in the U.S. dollar is really important to think about. Now, when this started to happen, I actually tweeted on Monday saying, we should think about the possibility that this could be a signal of something bigger brewing. And of course, everybody on Twitter said, no, this is, any trader ought to recognize this. You've just seen a parabolic acceleration of price to the upside. That means a blow-off top is forming. It's time to short this market. And of course, a whole bunch of people shorted that top in the dollar index, and so far they're making money. And I guess I look in the eyes of some of them like a fool for suggesting it might have been otherwise. I think it's really important at a time in history where we have the biggest superpowers in the world talking about nuclear escalation. And we have what I think has been very badly botched European Union policy against Russia, really creating a much, much worse energy and food crisis that will really, I think, damage Europe very badly in coming months and years. I think the scenario of an actual crash or collapse of the euro currency system is plausible. Now, I'm certainly not saying it's likely or it's coming. It's not a prediction. It's nothing like that. What I am saying is that in times like these, I think it's dangerous to look at what happened this week in the dollar index and say, it went parabolic up. That can only mean it's about to go parabolic down, and the only thing that anybody in their right mind would do is short it here. It was possible, didn't play out this time, but it was possible that that was the beginning of a signal that the entire system was breaking, because if the entire global monetary system were to suffer a breakdown, a worse than 2008 financial event that really would define the end of this fourth turning cycle, what would it start with? It would start with a runaway appreciation of the U.S. dollar, which is exactly what we just saw. So I think this was a good little fire drill. I think it's important to remember that although this one looks like it's playing out as a blow-off top, which was the more likely outcome, and it means that the world's not coming to an end. Great news. I'm just saying that this is a good time to reacquaint yourself with knowing if that dollar index went to 125 by next week, what would that mean? What would it be signaling? What would it be telling you? It would be telling you, I think, that something much worse than 2008 was starting to unwind. I don't think that's about to happen. I don't have any reason to think it would. But I do think that smart Boy Scouts and Girl Scouts would do their homework and want to acquaint themselves with what it would mean to see a sudden U.S. dollar runaway of appreciation in the dollar. And the way, of course, that would come about would be as a result of a global flight to safety panic into dollars and away from other currencies and assets denominated in other currencies. That's what you would expect to happen if you were actually seeing something on the scale of the pound sterling truly collapsing as a currency, or the euro collapsing as a currency, or a situation where the European Union was somehow doomed to break up because of an escalation of the difficulty in Russia. I'm not predicting any of those outcomes. Those are all outliers that are well beyond the scope of what's actually happening now. I'm just suggesting it would be good to do your homework and know what the signals are. And I would argue that a sudden appreciation of the U.S. dollar and a sudden increase in Treasury yields are the two warning signals that things are really starting to break on a systemic level. Looks like the potential oh my gosh, yellow flag warning that we got this week turned into just a wonderfully tradable blow-off top that a whole bunch of people who were more daring than me made a bunch of money shorting. So congratulations if you shorted the dollar on this peak. I'm just suggesting that we need to think about what big dollar dislocations like that could do to the global economy if this appreciation of the dollar continues. In any event, Patrick, let's move on to this week's post-game chart deck. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, look for the red button that says Looking for the Downloads. Nick Galarnik joins us now in the post-game segment as a new member of the post-game staff. Nick, welcome aboard.
Glad to be joining the team. This week's chart deck is titled, What's Next for the Markets? Patrick, we're going to kick things off with a chart of the S&P 500, which is trading at lows of the year as we speak. If we break the 3,500 level, it's probable that we test the 3,400 area, which is a pre-COVID high mark. What do you think about this?
Well, exactly. I marked on this chart this previous low from June. And not only did we test it and bounce yesterday on Wednesday, but, the rally lasted a whole few hours. It basically made it up just barely above 3,700. Any meaningful bounce should have easily been able to make it back to 3,900. And immediately we come in this morning with another round of selling. It's like being at the edge of a cliff. At this moment, if these previous lows give out, there becomes an air pocket. The first target is exactly about 3,400. Like you were saying, it's, I concur with that number. But, the question is what's driving this? If we continue to see that something is broken and it's really driven some sort of a liquidity event. The question is, do we see some sort of, multi-sigma move to the downside that causes some sort of final capitulation event that might wash us out to 3,200 or 3,000? Now, I'm not predicting that, but these are the types of conditions where we have to be aware that things like this can happen. And it's certainly going to be really interesting. The first thing is obviously to watch throughout today and tomorrow whether the previous low holds.
On the next page, we have a chart of the VIX, which is trading near 33. This tells us that we can expect more than 2% daily moves in broad markets and signals risk off. What are your thoughts here, Patrick?
Well, that's exactly it. 2% swings in the market is just par for the course now, right? So anyone surprised by 100 S&P point swing shouldn't be. And, the fact that we're over 25 and now above 30 is just really showing that that it's really risk off at this moment. The bigger question is there going to be just one blow off? Now, again, the market can hold these lows and can bounce, and this could become the short-term high of the VIX. But if we do see that the selling kicks into lower lows and it becomes more of a liquidity event, one would expect that we could have a very short-term spike in the VIX that blows it even north of 40 in that environment. Now, I think that any spike up there would be probably short-lived, but the fact that all year we've put in our highs around this 33, 34 area, and the fact that we're near year lows, it certainly is a lot of anticipation as to whether that kind of event can occur. So now let's move on to page 4 here, where I have that US dollar chart. And we had that almost accelerated explosion higher up toward 115. Didn't quite hit it there, but it really did. And at least it's pausing right now. Now, to me, just because such an overbought condition has caused the dollar to pause is not enough for me to in any way speculate that this is already a major dollar top. To me, even a pullback to 111 on the dollar index would be just a natural retracement to what it's going to be about here is that typically you see these 3 or 4 day pauses in a currency move and then it blasts off and continues in prior trend. Will we see that repeat itself, or is this going to start to form something much more of a meaningful reversal? And it's really early to be able to tell that here.
Eric, what are your thoughts on the USD?
I think what's important to think about now is how the apparent blow-off top in the dollar plays out. Are we going to see it go substantially down, back down to 100, meaning that this was a major top? There's a new trend that might come into play now? Or is this just going to pull back to 108, 110, and then move right on back up and move to new highs above 116 or 115, whatever the number was that we put in earlier today? I think it's really, really important to understand, are we going to just see a pullback? Are we going to see a change? This blow-off top should be a significant event. If it went much farther than it already went, if we got into the 120s, I would say that's getting into a real danger zone of the appreciation of the dollar blowing up emerging market debt and generally blowing up the rest of the global financial system. So I think if you saw the dollar go radically higher than the recent high, which I think is the most unlikely scenario, it would be a really, really dire warning signal. What's much more likely is this plays out as a blow-off top that, there's going to be some down now after the blow-off top. How much down? Is it a really big blow-off, or is it just a blow-off shaped pullback before the rally resumes? That, I think, is what's most important to watch.
On the next three charts, we're talking about the pound, euro, Canadian dollar, which have all been decimated recently. What are your thoughts on these charts, Patrick?
Oh, we got to start with that pound. I mean, we can talk about the interest rates in England in a moment, but what a capitulation. I mean, we saw a 1,000-pip move literally within less than 24 hours of trading. And it really was just one big washout. What we saw was obviously an intervention by the Bank of England, and that certainly alleviated some of the most immediate stresses and caused the bounce back. I mean, I think that at this stage, it's fair to speculate that even if the dollar continues higher, it's entirely possible that this washout could even mark the low already of the pound sterling. So often you might see scenarios where that bottom is retested. I mean, if we have another dollar run on the upside, the pound could retest its lows. But I think at this moment, when you see that kind of a crash event washout, that much of a currency move, that low that was established is going to technically mean something. And so this can be really interesting in the coming weeks, how this plays out. When we go to the euro, on the other hand, it did have a weakness. It certainly continues to deteriorate, and we now have finally seen the break of the parity level. With this breakdown move now occurring down to 95, 96 cents, it's actually achieved many of my downside targets. I find it really hard to be bearish the euro here from the price level, but certainly the trend remains incredibly weak. All rallies are failing, and there is no evidence that a new uptrend has yet begun. Any bounces here, they could sneak up to 98, 99 cents, but at this moment, unless we see a meaningful shoot above parity, I would be very alert about them turning right back down to retest the lows. And the last one we were mentioning there was that Canadian dollar. Looking at that US CAD, just an explosive move in the last 2 weeks. The US dollar against the Canadian dollar has been probably one of the more stable currency pairs that have been out there all year. And suddenly the US dollar rally just kicked in, and we saw almost a 700 pip move in 2 weeks. We're really seeing the entire currency markets really wobbling as the US dollar rally just is simply the most dominant trend out there.
Absolutely. Yeah. Watching the Canadian dollar fall about 8 cents in a couple of weeks is pretty alarming. But on page 8, we have a chart of crude oil now.
Yeah, and let's talk crude. I mean, Eric was referencing this downtrend, and really to me, though, it's all about the price action. It seems every time there's one of these 2, 3, 4-day rallies, it barely does a 50% retracement of the rally and immediately starts to sell again. The point of high interest now, to me, is around this 85-cent level or $85 level. If we see that these little rally attempts in crude oil can't beat 85, they could roll over and head right down to the mid to low 70s. To me, the only way the bulls are going to neutralize the sell cycle is to legitimately clear 85 and get it close to 90 again and let it stop making lower lows. Then we'll see much more neutral price action that actually could set up a bullish turn, and that simply is not there yet. Okay, so moving on to page 9, I just wanted to touch here on gold. And so gold, in my mind, has now completed a move to the downside. This kind of 1620 area was initially a target for me if it was to break to a lower low where it could go. With this bullish engulfing candle coming in here, or at least a bullish reversal candle, to me, we're going to get a little bit of a bounce, but there is so much repair work the bulls have to do to turn this back up. I mean, we could, even if it rallied to 1700 or 1710, could very easily just roll right back down and retest its lows. I think for gold, we're going to have to really see a US dollar top establish itself, and that would correspond with potentially with a basing formation where gold could put in a bottom, and just doesn't seem like that's there yet.
Eric, what are your thoughts on gold?
Well, today's green candle is certainly exciting, but what did it do after moving so far? So far up in one day, all the way back up to what, 1670 almost? It's still $10 below what we used to think was a bottom that we hoped would hold. So how much further we go from here? The stock market didn't even get really to new closing lows. I think that the stock market is probably not done here. If the stock market goes to all-out crash, I think it takes gold substantially lower. But let's see what happens. It does feel like there's at least a short-term bottom in.
Moving on to page 10 here, I have this chart on the 10-year government bond yield. And, guys, we hit 4%. It's unbelievable. I thought 3.5% was going to be such a huge hurdle, and the bond market just continues to get hammered on every single front. We obviously had the first tap of 4% create a little bit of a rejection here on the 10-year yield. But you know what? We've seen these temporary pauses for a couple of days, and then it just resumes. It's too early to know for a fact that some sort of a top has formed here. So much of these things have been hitting these extremes. It'll be really interesting to watch how the next week of price action continues to develop here.
Eric, what do you make of the U.S. 10-year bond yields trading up to 4%?
I'm not sure if we went over 4% briefly intraday. I saw 3.90 something on the 10-year yield on Thursday, and needless to say, that is pretty darn quick appreciation. Everybody thought 350 was never going to happen just a few weeks ago, and already we're flirting with 4%. This is definitely what to watch. It does feel like maybe we just put in a bottom in yields, top in the dollar index. Question is, how long does that trend go? So let's see what happens.
On page 11, we have the UK 10-year. This is where the carnage has been of late.
Oh, for sure. And what is interesting, and obviously the Bank of England intervened, and some people were skeptical of it. But when you start reading some of the stories, it was clear that there was some sort of a pension meltdown that forced that Bank of England to intervene, because the rumor was that the UK bond markets barely dodged a Lehman Brothers-like collapse. But this time it was obviously those pension funds that were the center of the event. Some sort of pension plumbing is causing this mess, and it'll be really interesting to see whether this intervention was enough to stem the bleeding. I mean, we saw the yields go from 1.7% on the gilts all the way up to like 4.5% in just a span of 2 months. Unbelievable move in this, and this is really starting to demonstrate the fact that the broader intermarkets are starting to break, and we're seeing things just accelerating into panic modes. It really makes me feel like even if things do get worse first, that something is going to give here in October. Like it's just unbelievable to see these types of moves.
Absolutely agree. And on the next three charts, we're talking about the mortgage REITs, investment grade corporate bonds, and junk bonds. Now, what are your thoughts on these charts, Patrick?
Yeah, I was looking at these mortgage REITs, and I've been trying to be far more positive on these. And in the last week, it's simply been a fail. I mean, at this moment, there seems to be almost no money out there, and there seems to be real selling, particularly even potentially from pensions and other types of funds that are stuck in the liquidity period, and these things are just getting hammered. And so with this current pullback, you're seeing just an outright acceleration to the point that these mortgage REITs are going back to the 2020 repo crisis period. It's like lightning striking twice. I'm finding it a little bit shocking to seeing this much carnage in these mortgage REITs. But last time around when they got here, it ended up being quite a buying opportunity, but it really feels like a very dangerous game trying to catch this falling knife. When we go here to investment grade corporate bonds, what we have to touch on here is that everything is selling. The investment grade corporates, even though the credit spreads, though, rightfully so, have not been blowing out in a crazy way. This has just been a bond market carnage right across the board. Whether it's this investment grade bonds on page 13, or whether it's the high yield bonds or junk bonds on page 14. Everything is getting hammered. Everything is getting hurt. And the problem is, how can the stock market rally when there's this much carnage in the bond markets? To me, the market just still is in such a critical stage. And while we there's a risk of everything still getting worse. It just feels like we're very close to some sort of a washout in all of this. It would be a shocker to me if this ended up being one extended bleed.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are in the last pages of the slide deck, or just go to bigpicturetrading.com. We're going to leave it there for this week's show. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, please tell our listeners what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find a transcript for today's interview, as well as a link to the slide deck from Jeff, as well as a chart book we just discussed here in the postgame, and a link to a number of interesting articles that we wanted to share. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.